You know what nobody's talking about right now? The fact that we're watching the silver market fundamentally break in real time. Not next year. Not eventually. Right now. Every single quarter for the past 3 years, the world has consumed more silver than it's produced. And that gap? It's getting wider. Let me put this in perspective. In 2024, the global silver deficit hit 215.3 million ounces. That's the third consecutive year of deficits. But here's what should make your ears perk up. The Silver Institute is projecting the 2025 deficit will reach 265 million ounces. That's a 23% increase in a single year. We're not talking about a supply crunch that's stabilizing or improving. We're talking about a deficit that's accelerating quarter after quarter. Now, I want you to think about what that actually means. Imagine you own a business, and every month you're selling more product than you can make. At first, you dip into inventory. Then that inventory runs low. Then it runs out. Then what? Prices have to rise. There's no other mathematical outcome. That's exactly where we are with silver right now. Except the inventory we're drawing down isn't sitting in some warehouse in Ohio. It's the COMEX vaults, the LBMA reserves, the strategic stockpiles that took decades to build. Let me show you what's happening on the supply side first, because this is where the story gets really interesting. Global silver mine production in 2024 came in at around 830 million ounces. Sounds like a lot, right? Except demand hit 1.2 billion ounces. Do that math. We're short by 370 million ounces before we even account for recycling. And here's the kicker. Mine production isn't growing. In fact, it's barely keeping pace with depletion rates at existing mines. Why? Because silver isn't like gold. About 70% of silver production comes as a byproduct of mining other metals, primarily copper, lead, and zinc. When copper prices are strong, you get more silver as a side effect. But when base metal prices are weak, or when those mines face operational issues, silver production drops, even if silver prices are screaming higher. The miners can't just flip a switch and produce more silver. It doesn't work that way. And there's another problem that nobody wants to talk about. The easy silver is gone. The high-grade deposits that made Mexico and Peru silver powerhouses for centuries, they're depleting. The average ore grade at primary silver mines has fallen by more than 30% over the past 2 decades. That means miners are moving exponentially more rock to get the same amount of silver. Higher costs, lower margins, longer development timelines. This isn't a supply response that can happen quickly. Now let's talk about where all this silver is going, because this is where the deficit story becomes absolutely critical. Industrial demand for silver hit a record 690 million ounces in 2024. That's up 9% from the previous year, and it's not slowing down. Solar panel production alone consumed 173 million ounces last year. The electronics sector took another 280 million ounces. Electric vehicles, 5G infrastructure, medical applications, water purification systems. Every single one of these sectors is growing, and every single one is structurally dependent on silver. Here's what makes this different from investment demand. Industrial users can't just decide not to buy silver because the price went up. If you're manufacturing solar panels and you need silver paste for the photovoltaic cells, you don't have a substitute. You pay the price, or you shut down production. That creates what economists call inelastic demand. Price increases don't reduce consumption. They just get passed along the supply chain until eventually they hit the end consumer. But it gets more interesting. Investment demand added another 329 million ounces in 2024. That's physical bars, coins, and ETF holdings. And this number is accelerating. In the first quarter of 2025 alone, silver ETF inflows hit 47 million ounces, the strongest quarterly inflow since 2020. Why? Because investors are starting to wake up to the same math we're discussing right now. They're looking at a market where demand structurally exceeds supply, and they're positioning accordingly. Now, I want to take you back to a moment in history that rhymes with what we're seeing today. In 1979, the Hunt brothers tried to corner the silver market. They accumulated over 100 million ounces of physical silver and silver futures contracts. The price went from $6 an ounce to $50 an ounce in a matter of months. Then the COMEX changed the rules. The Hunts couldn't meet margin calls, and the price collapsed. Everyone remembers that as a cautionary tale about market manipulation. But here's what they don't tell you. The Hunt brothers were buying in a market where there was still above-ground inventory available. Today, we're in a completely different situation. The world has been drawing down silver inventories for 3 consecutive years. COMEX registered silver, the stuff that's actually available for delivery, has fallen from over 150 million ounces in 2020 to under 45 million ounces today. That's a 70% decline in deliverable inventory, while open interest in silver futures has remained elevated. Let me paint you a picture of what's happening in the physical market right now. In January 2025, a major silver refinery in Switzerland reported a 6-week delay on 1,000-ounce bar orders. 6 weeks. For an industrial commodity that's supposed to be readily available. Premiums on physical silver coins are running 25% to 35% over spot price. That's not normal. That's not a functioning market with adequate supply. That's a market under stress. And the LBMA, the London Bullion Market Association, that essentially runs the global wholesale silver market, they're seeing the same thing. Their vault holdings have dropped by 18% over the past 18 months. Where's that silver going? It's being shipped east. China imported 6,200 tons of silver in 2024, up 57% from the previous year. India took another 4,800 tons. These aren't speculative flows. This is physical metal, moving from west to east to feed industrial demand and investment demand in economies that are still growing at 5% to 7% annually. Now here's where this connects to something bigger. We're watching a fundamental shift in how the world thinks about monetary metals and strategic commodities. Central banks bought 1,037 tons of gold in 2024, the second highest annual total on record. They're not buying silver because silver isn't classified as a monetary metal in the same way. But private investors are making a different calculation. They're looking at gold trading at $2,900 an ounce and silver trading at $32 an ounce. And they're seeing a gold-to-silver ratio of over 90 to 1. Historically, that ratio has averaged around 60 to 1 over the past century. In Roman times, it was 12 to 1. Even if you just assume a reversion to the modern average, that implies silver should be trading closer to $48 an ounce at current gold prices. But if you factor in the supply deficit, the industrial demand growth, and the inventory drawdown, the fundamental case for much higher silver prices becomes almost mathematical. Let me tell you about something that happened in 2011 that most people have forgotten. Silver hit $49 an ounce in April of that year. It wasn't because of a supply deficit. It was purely speculative momentum driven by QE2 and inflation fears. The market was in surplus that year. Mine production was growing. And yet silver nearly hit $50. Now fast forward to today. We have an actual structural deficit. We have inventory drawdowns. We have industrial demand that's mandatory, not optional. And silver is trading at $32. Does that make sense to you? Here's what I think is happening. The paper silver market, the futures and derivatives that trade on the COMEX and in London, they're still pricing silver as if supply and demand are in balance. But the physical market is telling a completely different story. Those 6-week delays at Swiss refineries, those 30% premiums on coins, that's the physical market screaming that there isn't enough metal to go around. At some point, those two markets have to converge. And when they do, the price adjustment is going to be violent. Now, if you're sitting on retirement savings and you're thinking about how to protect purchasing power in an environment where physical commodities are becoming scarce, there's something you should know about. I put together a free guide on how gold IRAs work, specifically for people with $100,000 or more in retirement accounts. It covers how you can get physical precious metals into your IRA without triggering tax penalties. It's in the description below. Worth looking at if you're thinking about diversifying out of paper assets into something tangible. No pressure, just information. Anyway, back to what's happening in the silver market right now. Let's talk about what happens when a deficit persists for multiple years. You start to see behavioral changes in the market. Industrial users start securing long-term supply contracts at fixed prices because they can't risk production shutdowns. That locks in demand regardless of price. Investors start hoarding physical metal because they don't trust paper claims. That removes supply from the market. Miners start prioritizing silver production even when it's a byproduct, which means they're making operational decisions based on silver prices, not just the primary metal they're mining. All of these behaviors reinforce the deficit. They don't solve it. The only thing that solves a structural deficit is either a massive increase in supply or a massive decrease in demand. And I just explained why supply can't respond quickly, so that leaves demand destruction. How high does the price have to go before industrial users start finding substitutes, or before solar panel manufacturers redesign their products to use less silver? Nobody knows for sure, but the estimates I've seen suggest silver would need to trade above $60 to $80 an ounce before you see meaningful demand destruction in the industrial sector. Think about that. We're at $32 today. The market would need to nearly double or triple before industrial demand even starts to slow down. And in the meantime, every quarter that passes, we're drawing down another 50 to 70 million ounces from global inventories. At the current rate, we're on track to deplete above-ground inventories to critically low levels within 18 to 24 months. What happens then? Let me give you a historical parallel that's actually quite frightening. In the 1990s, there was a massive above-ground inventory of silver, estimated at over 2 billion ounces. That inventory had been built up over decades from old coins, industrial recycling, and government stockpiles. The market was in surplus almost every year. Silver traded between $4 and $6 an ounce for most of the decade. Miners couldn't make money. Exploration stopped. Nobody cared about silver. Then, something changed. Digital photography died and was replaced by smartphones. Solar panels became economically viable. Electronics demand exploded. Suddenly, the world needed a lot more silver. And that 2 billion ounce inventory? It got consumed. By 2015, above-ground inventories had fallen to around 800 million ounces. Today, they're estimated at less than 500 million ounces. We've burned through 75% of the world's above-ground silver inventory in just 25 years. And here's the terrifying part. We can't rebuild that inventory. The silver that came from old coins and government stockpiles, that was a one-time source. It's gone. The only way to rebuild inventory is through mine production exceeding demand, and we just established that's not happening. We're in a deficit. So every ounce that gets consumed in a solar panel or an electronic device, that's an ounce that's effectively gone from the market for decades. Silver is being demonetized and industrialized at the same time, and nobody's paying attention to the math.